Hi, Dr. Scott here at your service. Let's talk the accounting cycle. Start with why. What's the accounting cycle all about? Well, it's how we get from a transaction, possibly followed by an invoice, all the way down to getting them onto the financial statements. And those are the financial statements that we use to communicate the performance. We're back to financial accounting, understanding balance sheet, income statement, statement of cash flows, and the statement of retained earnings or stockholders' equity. And with that, we can tell a lot about a business. Accounting is storytelling. So let's see how that story is created and initiated. So I'm going to pop over to ChatGPT. And with that, we're going to take a look and let ChatGPT kind of help guide us out of the gate to get us going. And in doing that, by the way, I encourage you, if you use something like ChatGPT, set up projects. The projects themselves down here, I have a project for accounting assignments. It's a good place to store your things. It's almost like a file or a folder when you try to put your documents somewhere. Well, I'm putting all my communications in this class in one area. And the nice thing is that the context window, the area that stores that information, will remember previous stuff. And it's helpful as we go forward. So I'm going to start. It knows that I'm an accounting instructor. It has some background that we're teaching a financial accounting course and helping students in the college level figure this stuff out. So I don't have to do all that fancy prompting to get it going. So I'm going to start out. Can you please help me? I always say please and thank you. My mama taught me right, I think. Please help me understand and develop the process for the accounting cycle. Let's see what it does with that. So it started to be thinking. I use a thinking model. There are reasoning models and other good things. And in one sentence, the repeatable workflow that turns raw transactions into reliable financial statements representing the system for the next period. So again, it's from the stuff that's happening to the reporting of it. And so let's go through individually what each of those processes are and make sure we have some clarity on that. So we start out with a business event. Something happens. We measure it in monetary, we measure it with money. That's stable dollar, it's monetary unit, one of the assumptions we talked about previously, or that accounting is founded on if you haven't watched previous videos. Examples, cash sale, inventory purchase. Does it change assets, liabilities, equity, revenues, or expenses? And you might have seen this picture before. I'm going to go ahead and draw a whiteboard picture for how this stuff fits together. And we're going to go ahead and look at two T accounts. And those T accounts are in the form of, see, there we go. And we're going to change for a nice blue color. Our assets, liabilities, and equity. Here's our balance sheet. We got our revenues and expenses. And that's our income statement. And so does it follow one of those categories? All transactions need to. So when we're buying something, we might have something like cash get affected. And then as you probably know, things like cash are an asset. So would be inventory. So would be things like accounts receivable. So would be prepaid expenses, like prepaid insurance expense. Okay. So anything that affects any of those accounts is going to get recorded. Let's go back to our ChatGPT and take a look at where we're headed for. And we'll go back and share that screen for us. And we'll continue with the explanation. So anything to affects the accounting equation. All right, analyze a transaction. So we have to decide what accounts get hit. We look and say, okay, and at least two things are going to get hit with every transaction. Not just two, but at least two. So we're saying, did this affect assets, liabilities, equity? And then we look at the accounting equation And we realize revenue less expenses, that net income ends up flowing into equity as well. So we got to look at and get in that habit of saying, okay, we bought inventory and account. Inventory changes and accounts payable changes. One asset changes, one liability changes. Okay, that kind of makes sense. That's the accounting equation. We're in balance. Assets equal liabilities plus equity. We haven't touched revenue or expenses yet. We're just recording an obligation to pay for inventory. If we paid for inventory with cash, we'd have two assets that get hit. One cash going down, one inventory going up. So the net change in assets is going to be zero. So a recorded journal entry. Proper journal entry has at least one debit and at least one credit, but always stays in balance, debits equal credits. And we just use the proper account titles that are associated. We then take the chronological list, those journal entries, and we post into the ledger. The journals to the ledgers, JKL, that's, I used to remember it alphabetically. Journals go into ledgers. And ledgers are those individual T accounts. They're the T accounts that have, and let's go back to our picture of our whiteboard and see what those T, well, you just saw two T accounts. What did I do? I had the T accounts for a balance sheet and an income statement. But we're going to go one step further. We're going to go ahead and take a look at it's the whiteboard. We're going to take a look at the journal entry and the T accounts. The T accounts or the ledgers are really just basically a page. So we're going to look at what we had before. And we're going to take that inventory example, and I'm going to actually post or pop here our accounts payable on our balance sheet. So we've got some accounts to work with, not accounts receivable. You never debit a payable and credit a receivable or vice versa. Payables are things you owe to your vendors, also called trade payables. Receivables are owed to you by your customers. So your receivable is your customer's payable. But for you, one business, it's kind of receivable, maybe you have receivable and revenue. And that washes out to equity. We'll talk more about that. And we have in the past with those debits and credits. Let's go ahead. Let's take a look at our inventory purchase example. So if we bought inventory, and the nice thing about journal entries is you pick one side that you know. Cash is the easy one typically. Cash goes up, we're debits. Cash goes down, it's a credit. In this case, well, let's say we pay for our inventory with cash. So we know cash is going down. We know that's a credit. So I'm going to put an XXX holding here. And let's say I got $1,000 of inventory, but I know my cash is being credited. Done deal. Now, you probably can figure that out. What did I buy with that cash? I bought inventory. Be careful to realize that that inventory is not an expense. We don't put that on our income statement. We have zero expenses. We even have zero revenues. We do have $1,000 down asset cash, $1,000 up asset inventory. Assets net change is zero, but we bought some inventory that we can sell. And remember, assets are those things that we own, liabilities are things we owe, and equity is the remainder by ownership interest. So we'll have two T accounts that we're going to start here. So I'm going to go ahead and take a look at those T accounts by looking and saying, oh, I've got a T account for inventory. I've got a T account for cash. Now, where journal entries are a chronological listing of all transactions, the T accounts or the ledger accounts, again, think of them as a page, one page for inventory, one page for cash. I'm going to debit my inventory for 1,000. I'm going to credit my cash for 1,000. And my bottom line in each of these two totals, I've got 1,000 inventory with a debit balance. And it's kind of interesting to have a negative cash balance. Usually you start with maybe something like $100,000. And maybe I'll put 100K in cash. And I'll pop 100K in equity. I'll put that in common stock account just for kicks so we can stay in balance. I like to keep things in balance. I'm sure you do too. So do that. So I've got my cash at 100. I spent 1,000 and I'm ending up with a $99,000 So this, move it up. $99,000 net. Okay, now everything's in balance. I clear that 99. My inventory is going to be 1. And I've still got 100,000 in assets and 100,000 in equity and 0 in liabilities. Did not use accounts payable this time. Let's go back to where we were and then go back into ChatGPT and help round out where we're going and determining what more the accounting cycle takes. So we post those general ledger or those T accounts or those pages, and you'll see an ending cash balance and ending inventory balance that we just showed. Then we prepared an unadjusted trial balance. What's an unadjusted trial balance look like? Well, let's go ask ChatGPT and then I'll explain it. Show me an unadjusted trial balance. And what that means is taking the bottom column, bottom total from each of those T accounts or from each of those pages of the ledger and saying, oh, I got $99,000 in cash. Boom. Oh, I've got $1,000 inventory. Boom. In this case, I've got a debit column, a credit column. Here, the cash is 16,450. Our inventory, we don't have any, but we do have supplies inventory of 1150. Accounts receivable, prepaid insurance, equipment, accumulated depreciation. Oh, that contra asset account. It's not a liability. It's a contra asset. And you'll notice everything above this line, above accounts payable, that happens to be an asset. The next category, accounts payable, unearned revenue, notes payable, those are all liabilities. Then we have common stock, retained earnings. Oh, that's equity. We have service revenue, that's revenue, cool. And salaries expense, rent expense, utility expense, and our debits equal credits. Our total columns are equal. So that's what a trial balance looks like. And it's called an unadjusted trial balance because the unadjusted trial balance doesn't have that month-end adjustment or quarter-end adjustment or year-end adjustment for depreciation, things we haven't been billed for, but we got some interest expense on a note. Or we have some revenue that might have been unearned revenue, they make it earned revenue. We have some of that prepaid insurance as an asset. We need to move it out of the insurance, prepaid insurance asset and move it into insurance expense on the income statement. So we're always, we'll talk more about adjusting journal entries in another video, but we're always adjusting one balance sheet account and one income statement account in those adjusting entries. There's one account you never use. You never use cash. Cash is not an adjusting entry. It's not an adjustment. It's a transaction. I spent money or I got money. One or the other, it's a real transaction, not an adjustment. So you get a bank statement and said, boy, they charged me $20 for checks. Cool. That's a charge, bank service charges or bank fees of $20, not an adjusting journal entry of $20. There's a cash adjustment out of our account that was spent. Then we have recording adjusting entries. We'll talk more details, but accruals, also known as estimates, and deferrals, which are adjustments. Sometimes we're not given a bill, but we know we incurred something, or we have to do better matching. Or maybe the wages that we're paying on January 2nd were for December activity of our employees. So we have to accrue or estimate the amount of wages. Now, those estimates can be pretty accurate. We can know exactly how many hours our employees worked. We can know what our salary folks make, and we can come up with a pretty good number. But it's still an estimate because no one gave us a bill for our employees' wages. Or if you have a 90-day note that's issued December 1st, well, we got a month's worth of interest from December 1st to December 31 that we need to record. And nobody sends us a bill for that interest. We still need to record it. So the adjusted trial balance, we get those adjusting entries in the next column, and then we have an adjusted trial balance, which reflects those adjustments. And I'm going to ask GPT here in its infinite wisdom, please share an adjusted trial balance. And by the way, just the names of the accounts in that first column happen to be called the chart of accounts. And then to get the trial balance, we get the debit or credit balances in the next column to go with that. And now we have a trial balance unadjusted. We then have another column for our AJEs, our adjusting journal entries. And then we tie those across. And if we have adjustments to receivables, if we have adjustments to prepaid expenses, unearned revenues, variety of payables, we go ahead and put that in the adjustments column. And then we have one more column that is the adjusted trial balance. And from that, we'll go ahead and take out all of the, they didn't include, didn't ask, they gave me what I asked for, didn't they? Please include columns, because I want to give a full picture for the unadjusted trial balance, the adjustments, and the adjusted trial balance. Okay. And again, you could use this as a study tool. You can say, give me 5 quiz questions on this stuff. Give me 10 quiz questions. And that's not a bad study aid to help you figure out how to use these things. There's another video on the study and learn mode. And I would urge you and encourage you to use that, because that really easily doesn't give you the direct answers. You give it a problem, it'll help process with you and help you better understand. So that's study and learn mode. And actually, I'll show it to you here. If you go in, I'm going to more. It's a study and learn mode right there. And I would encourage you to do that to practice. You can create flashcards, you can create quiz questions, you can do all kinds of things for you. But let's take a look at what it created here. Okay, so we have a debit and credit, unadjusted. And then we have adjustments, debit and credit. Notice there's adjustment to supplies. Oh, it looks like we must have used up some of those supplies. We started with 1150. So we went over and counted on top of the in the storeroom, and we say, oh, we must have used $500 worth of supplies. So I'm sorry, there's $500 left of supplies on the shelf, so that means we use $650. Okay, prepaid insurance out of that $2,400 sounds like that could have been a 6-month insurance plan, and we used a month of insurance, and this is for the month ending January 31. If you notice X6. So I go in there and say, I must have used $400 worth of insurance. Now notice on the other side of the 650 and of the 400, there's actually hopefully there better be, there it is, a 650 for supplies expense, debit balance, that's the expenses, and a 400 for the insurance expense. That kind of works out. We've got depreciation of 500. If I scroll back up here, you notice accumulated depreciation has a credit balance of 500. You say, wait a minute, accumulated depreciation shows up with the assets, doesn't it? Sure enough, it has a credit balance. That's kind of strange. Sure enough, it is actually called a contra asset account. It's an offsetting asset account. So if I ask what the net value of my equipment was, you take that $25,000, you deduct the 500, and you would have saying, oh, actually it's 1250 to start, and another 500 this year or this month. So I've got 1750 total. I've got my my adjusted trial balance, my ATB. I've got 25,000 less the 1750 total. The net book value of that equipment is not 25,000, not 24,000, but 23,250. Got a debit of 25, a credit of 1750, and I've got the 23,250 as a net book value. Does that mean I can sell the equipment for 23,250? Probably not. That's just a book value. It's not the market value. It is a book value based on historical costs. So that's what's going on with the adjusted trial balance. So we'll scroll back up and see where the rest of the steps take us. So we actually have the adjusted trial balance, those last 2 columns. Then the reporting phase, financial statements, income statement, retained earnings, balance sheet, cash flow. And again, first block is assets, second block liabilities, third block is equity. Then we have revenues and expenses. And then we close what are called our temporary accounts. Now, what's the difference between a temporary and a permanent account? Well, a temporary account will zero out at the end of the month or end of the year. A permanent account will stay. So let's take, for example, our cash or our inventory. Do you think cash goes to zero at the year end? I should hope not. Or inventory? Not unless we sell it all. But does our revenues go to zero? Do our revenues go to zero? You bet. We start fresh at the beginning of the year or in the beginning of the month. Our expenses go to zero. Our depreciation expense will zero out at the end of the year, but the permanent account, anything on the balance sheet like accumulated depreciation, stays in place. Where depreciation expense, wage expense, service revenue, product revenue, cost of goods sold, all that stuff gets zeroed out. in the end. So that's the process. We zero out those temporary accounts. They wash out into retained earnings, and net income ends up in retained earnings. And that's what the accounting cycle does. It takes us through the process of identifying transactions, getting them reported on the financial statements. Hopefully that was clear, understandable. If you have any questions or needs, don't hesitate to reach out. Look forward to being in touch and of future service. Thank you for your time.